more value you can provide in your business, the more of a price you can charge. The higher the price, then obviously the more profit you generate. So you want to think about pricing as value proposition for anything. So whatever your business is selling or providing, it's what value does the customer get from that experience? And the more value your customer can get out of that experience, the higher you can make that price.
3, 2, 1.
Here we go.
Welcome to Inside The Hive with Kyle and Brandon. Join us as we explore business, real estate, current events, and personal growth. We dive into the latest trends, offer valuable insight, and share stories. Thanks for tuning in. Sit back, relax, and enjoy the show. Man, appreciate you being here and everything. And I've heard so many good things about your company. And now that we're signed up with you as well, we're pretty excited about it. But how did you get into this? Because it seems like every company, I would think their financials would already be, I don't know, part of it. You start a company, you get a bookkeeper, you kind of start going down that path. Yeah. And now all these different companies that we know, business owners, want to use your services to take that off their plate. And how'd you even get going? If you wouldn't mind starting from like the beginning, like that would just be.
No, for sure. So, so we take it way back. It's funny. I was a finance major in school.
Oh, really? Where'd you go?
I went to Cal State Fullerton. And I wanted to be an analyst, right? And so I started pursuing jobs as an analyst. And what I didn't realize and what they don't tell you in school is you don't get a job as an analyst coming out of school. Basically, they want 3 to 5 years experience, which of course, if you're a new grad, how are you going to have that? And so I'm like, okay, that route is not going to work, right? And then I didn't want to be like a sales guy. I didn't want to be like a financial advisor because that's typically the route that like most people in finance go towards because that's the only job you can come out as like selling life insurance.
Yeah.
Doing one of those things.
And they get the Series 6 and the Series 7 and all that stuff.
It just wasn't my thing. I mean, sales is not like my natural forte.
Yeah.
And
These guys are hustling, man.
Yeah, that they are. And I've definitely, it's funny, like owning a business, I've had to learn some of those things, but that doesn't come inherent to me, right? So then I was like, okay, well, accounting complements finance well. Why don't I get an intern as an accountant? And I found someone that I was able to intern that with. I thought it'd be good to bring both skills to the table. And so I started with like a small bookkeeping firm, just learning like the basics, like very basic, very small companies, just learning like debits and credits and, basic accounting functions. And I was with kind of a new entrepreneur herself. She had just started her business and she was growing. She was great at sales. So she would get these opportunities for like bigger and bigger clients. And she'd come back to me and say like, Brandon, can we do this? Can we make this work? And I'd say, yeah, you bring in the business and we'll figure it out. Like I've always been good at like reverse engineering and figuring out how to make things happen. And so we got to bigger and bigger opportunities. And it went from like bookkeeping to like, hey, we need a controller. Hey, we need a CFO. And so, being in a finance background, right, I learned those skills in school and I was able to start actually applying some of those things that I learned and was able to kind of develop my skill set and, hard knocks, like learn the hard way and, fake it till you make it sometimes, right? Yeah. And then so we got bigger and bigger opportunities. And all of a sudden we were no longer a bookkeeping firm. Now we were a controller CFO firm. And the business was growing and there had been talk along the way about, having me become a partner and it just didn't happen.
I don't mean to interrupt, but
Sure.
I just that you hit on something that I've always been so curious about.
Yeah.
What is the difference, man, between a bookkeeper, a controller, and a CFO?
Yeah.
Because I think people use them interchangeably.
They do.
And I don't know if I could even tell you the difference between a controller and a CFO.
I hear it every day.
Okay.
Every day, right? It's like you hear because you have bookkeepers calling themselves CFOs.
Yeah.
You have bookkeepers calling themselves controllers. And so it's like, so what is the difference, right? In my mind, a bookkeeper is data entry. Right. So like the day-to-day accounting functions is done by a bookkeeper. So like accounts payable, accounts receivable, basic data entry of like what's going on in your bank statement or your credit cards. That's a bookkeeper. And bookkeepers are really good at data entry, but bookkeepers don't understand like sophisticated accounting. And so what happens is as your business starts to grow, you need more sophisticated accounting within your organization. And that's typically when you make a move. You may have heard like cash versus accrual accounting.
Oh, yeah.
Right. Cash-based accounting bookkeepers can do because all they're doing is data entry of what they're seeing on their bank statement or on their credit card. By the time you get to accrual accounting, you need a lot more sophistication within your financials. So that's typically when you then make the jump to, okay, I have my bookkeeper doing the day-to-day, but now I need a controller. And what a controller does is they formally close the books on accrual basis, right? And so what's the difference between cash and accrual, right? Cash is cash in, cash out. Money comes into your bank, it's income. Money leaves your bank, it's an expense. Accrual is matching revenues and expenses in the same period. And so, like, what does that mean? What's the difference, right? Well, think about if you have a business where you have net terms with a customer, okay, and you give your customer net 30 terms. Well, if you're just going based on when money is received into the bank, okay, if your customer pays you 30 days after you invoice them, now you've got timing differences between when you actually perform the work and when you receive payment. Vice versa, let's say you have net 30 terms with vendors, okay? You're paying your vendor in 30 days, but actually they performed their service 30 days prior. And so you end up with these timing differences. And when you want to look at your financials to see like how profitable is my company or how are we performing, if you have these timing differences, you're going to end up with significant swings month to month in your financial statements. And you really never get an accurate picture of like how profitable is my business? Are my margins where they need to be? And so what accrual does is it takes the timing differences away and it basically smooths everything out, puts it in its proper place, and gives you that data that you need to see like, okay, how is the company performing? And so that's what a controller does. But where a controller typically stops is just closing the books. Okay, they close the books. They'll give you basic reporting. They may even do like a basic budget, but that's kind of where they stop. And what a CFO is a CFO is no longer looking at what happened in the past. They're more looking forward thinking. Okay, so they're taking what's transpired, how do we take that data and then project into the future or forecast where is this business going, or more deeply analyze beyond just the accounting data, but actually doing, putting the data into spreadsheets and doing some more in-depth analysis. That's what a CFO does. And so unfortunately in today's world, these terms are interchangeable. You have bookkeepers, because bookkeepers know if they call themselves CFOs, they could charge more money. And so you end up with situations where a lot of bookkeepers are calling themselves CFOs. You also end up in situations where very small business owners are like, hey, I need a CFO. The reality is you don't really need a CFO. I would say that, not always, but most companies, if you're under 5 million in revenue, you really shouldn't have a need for a CFO, right? The CFO is really when your business starts to scale, you have a controller in place already and the bookkeeper. So you're not going to make the jump from bookkeeper to CFO. You need the controller. That's a very important piece along the way. If you already have a controller closing the books and you have your bookkeeper, and then, that controller isn't giving you enough of that forward-looking analysis you need, that's when a CFO comes in to play. But what happens is a lot of people, they're like, I need a CFO. And maybe they work with a great CFO. But if that CFO is working with a bookkeeper and that bookkeeper is giving you like that basic low-level accounting data, well, it becomes garbage in, garbage out. Yeah. So the CFO can't give you proper analysis if they're not getting accurate information themselves. And so that's where a lot of the disconnect happens, is a lot of people get frustrated because they want to work with a CFO, whether that CFO is qualified or not, and they're not getting what they need because their books aren't even getting closed properly. And I could tell you that if you have a CFO and they're calling themselves a CFO and they want to also close your books, typically a red flag, because good CFOs don't want to be closing the books, right? Good CFOs want to be doing the analysis. They don't want to be in the accounting. So it's important to make sure, like, what does your business need, and making sure that you find the right person or organization that supplies these different service levels, right? But making sure you're getting exactly what you need.
And like, of all these companies that you go into and help out, like, do any of them even have good bookkeeping going on? Because the CFO is kind of a cool term. Like, oh, I want to get a CFO. We're big enough. But I like that, like garbage in, garbage out. Like, do they even have those processes? Are they even reviewing a statement, whatever that statement is, on a monthly?
I mean, it's I would say
you saw the opportunity there, maybe.
I'll say that, for every 10 financial statements I look at, 9 are done wrong, right? And I would say 7 out of 10 are done pretty significantly wrong. So going back to like data entry, right? Any bookkeeper can do data entry. They need oversight. If you don't have oversight over the bookkeeper and you're just relying on that information to be accurate, that's where you put yourself into a situation where you may think stuff was being done right, and the reality is it wasn't. And so that's typically what I see. And so the bookkeeper is the most cost-effective solution. They're going to get the data in. That's all I really care about, is that the data is in. Once it's in there, then it's a matter of, okay, now taking that, reclassing it, moving around, but you need someone higher level to be doing that. The bookkeeper alone typically is not going to be enough.
But they need oversight, obviously. I mean,
they need
to even know where
oversight.
to categorize things. And
Exactly, because their job is just to get the data in. They're not even looking at it after. You know, when I review any client, first thing I do is I look at month over month changes on the balance sheet and P&L. And it's pretty quick when you can find all the red flags that come in. And so that's my kind of hack, if you will, to know if your financials are being done right, is like take a trailing 12 month, look month over month, and do you see the proper changes occurring? You know, like if you look at, you know, let's say you bought a car and you have a loan on the books and that loan amount isn't changing over the last 12 months, there's a problem, right? Like, or maybe they're booking that entire payment onto the loan, but they're not accruing, you know, there's no interest amortization, right? Like those are the things that typically I'll find. And it usually starts with the balance sheet because all the demons lie on the balance.
Well, that's a good thing to jump into. Is you mentioned the balance sheet and the P&L.
Yeah.
I know there's like 3 major financial statements that a small business owner should be any business should be looking at.
Sure.
But what are they, just so for our listeners to understand what you should be looking at?
Yeah. So, I mean, most people have heard of the P&L, also known as the income statement, right?
Yeah.
Like that's okay. How has the business been performing over a period of time, a given period? Maybe it's the last month, 3 months, 6 months, year to date. It's going to show you, okay, what were the revenues that came into the business? What were all the expenses? And what was the net income or the profit that the business generated? That's where most people stop, is they just look at their P&L, right?
I think I've stopped there.
Yeah.
I think I've stopped there many times. I'm like, what came in? What do we spend? We're good.
Exactly.
I made money. That's, yeah.
And so where I like to start is with the balance sheet. And so the balance sheet is, unless you're an accountant, it's a little bit more theoretical to understand what a balance sheet is, right? But a balance sheet is basically telling you, for all the assets that your business holds, okay, are those assets funded by debt, or are those assets funded by equity or profits? It gives you a health check on how strong is my company. So like, for instance, let's say you've got $1 million in cash in the business and you think, oh, my business is doing great. I got $1 million in cash. Well, if you took out $1 million loan to get that cash, well, you've got $1 million in assets, you've got $1 million in liability. The net worth of the business is zero because you now owe $1 million back. Right? But let's say you had $1 million that you've accrued over many years of profits. Okay, well, now that's all in equity, not debt. And so that puts the business in a much more comfortable position or healthy position. So you start with the balance sheet first, because the balance sheet is, like I said, that's where the demons lie. That's where, when someone doesn't know where to categorize something or put it, they'll usually throw it somewhere on the balance sheet. So you want to start making sure that the balance sheet is accurate. And then once the balance sheet is accurate, then you can go to the P&L and say, okay, now that I know that the balance sheet is correct, now I can trust the information I'm looking at on the P&L. And then the last one you're mentioning is like a cash flow statement, right? Or statement of cash flows. And what that does is that tells you basically where your cash is going. Because going back to accrual is matching revenues and expenses in the same period. So on paper, your business may be very profitable, but if your customers haven't paid you, well, you have no cash flow.
I have a story about that as well. Like that when we first started our business, someone told us, cash flow can kill you. And I had no idea what that meant. And we ended up getting a pretty prestigious client. We started working for SpaceX for a little bit. They take months and months to pay. So you do all these services, you put all this money, and you're not getting it back for like 120 days. And it could be crippling. And then we did some work for JP Morgan Chase and these other ones. These larger corporations take a long time. And that was something we learned the hard way about. You can't, even if you're awarded these projects, sometimes you can't take them on unless you're large enough to sustain that period of time.
Absolutely.
Yeah.
Absolutely. That's huge, right?
Yeah.
So a lot of smaller businesses find themselves in these situations where either, they end up with a large client with large terms, or they have a lot of concentration risk, which is one of the other red flags. Like if 80% of your revenue is coming from one client, if something happens with that client, puts you in a tough situation. So you invoice the customer, that's great. To your point, is it is it due on receipt? Is it 30, 60, 90, 120 days? Do you have the financial runway to carry you until your customer pays? And so one of the big reasons that I advocate for controller services beyond just giving you accurate financials, right? Because, okay, maybe you're the kind of person who doesn't give a shit about your financials. You don't even look at them, right? You know, you've got in your gut that the business is going well and you just want to put your focus there. Well, guess what? Banks or lenders, they want to see accruals. They want to see financial statements done accurately because then they can actually give you the healthy working capital you need to grow your business. So in the case of that example, if you've got a client who's paying you 120 days, but you're a very healthy, strong, profitable company, well, you can find working capital to help get you through those hunches. I'm not telling you not to go with that kind of business. Just make sure you've got the runway to carry you. And if your financials are done accurately, banks, you want to create trust. You want the bank to feel comfortable that what they're seeing is accurate and that it's done professionally, and that goes a long way. That's actually I built my business working with banks because people would come into the bank looking for a line of credit. The bank would look, the banker would say, great, send me your financials. They'd look and say, oh, this is not going to pass underwriting. But hey, I know this guy, Brandon, he can help get you set up. So that's kind of how my business built.
I mean, if it's a little overwhelming and you haven't even started to review these 3 reports yet, like what are some simple ways that someone could kind of dive into that besides like actually reviewing them, but maybe some little tips there of like what to look for on these before like really reaching out to a third party to help move forward?
I'm of mind where it's like, hey, if you're not an expert in something, go with the experts. So I would say that I advocate for third parties just for that reason. Now, I would say that if you want to kind of try to tackle it yourself, step one is like, just go on YouTube and like learn like what should a P&L look like. Learn, you can, in today's world, you can get so much information if you've got the time and availability to learn it, right? So you can go look at, okay, like what should accurate financials look like? What are some red flags I should be looking for, right? If you want to be kind of proactive yourself and maybe more cost effective, and then you really want to kind of drill down, right? Like actually look at, okay, so it's telling me that it cost me this much for this, and then actually go into the detail, like, did it really? And do I know that something happened? Maybe it hasn't transpired yet, right? Maybe we haven't gotten the bill yet, but I know that I did the work in August, right? We're in September now. But if I'm doing the August close, I want to think about, if I'm doing accrual, okay, what work did I do that I haven't maybe even invoiced my customer, or what work did I have performed for me that, okay, maybe I haven't received the bill yet, but I should be factoring or accounting for that in the month when the service was performed. And so those are just some of the simple things, but start with the balance sheet. So let's go back. Like a balance sheet is assets equal liabilities plus equity, right? So when you go into QuickBooks and you pull a report, it's going to show you the balance sheet, and that's how it's going to be structured.
Hey, I got a question on that. Do you recommend a QuickBooks or anything? Or
That's a good question
that's
too,
a nice,
man.
simple accounting software?
I mean, QuickBooks is the monopoly on the market.
Yeah,
what I would say,
sure.
what I like about QuickBooks is that it's very easy to use.
Mm-hmm.
Now, the flip side of that is people think because it's easy to use, they're always doing it right.
Oh, this is easy. I got it.
Exactly. They're like, oh, I'm doing everything right. I'm putting the data in. But as I mentioned, you can put the data wherever you want to put the data. That doesn't mean it's being put in the proper place.
I think even the online system like starts doing it automatically for you.
And you want to be careful because it'll start to put things in places, and maybe you put something in a place one time, and it's going to always want to put it there. Now, maybe that is always the case, but it's not always the case. So you always want to don't always rely on automation. I think that's a big thing I see a lot is people rely on integrations or automations, right? So somebody's like, oh, my invoicing system integrates with QuickBooks. I'm fine. Everything's good. Well, no. I mean, just because it integrates, that doesn't mean it was set up properly. That doesn't mean it's all working effectively. You could still end up with a huge mess. I actually like to avoid integrations. I like to silo information.
And interesting.
Yeah. And I do that for a couple of reasons. Number one, I can keep the books much cleaner because if you're throwing a bunch of unnecessary data, and like, let's say I'm doing my invoicing in a third-party system, not QuickBooks, but I'm using QuickBooks as my accounting system. Well, a bookkeeper is not going to know how to do this, but a controller would know how to, reconcile everything on your invoicing system and then journal over the data that's needed onto your QuickBooks, now you don't have to push a bunch of information. I still have all the reconciliation or the backup or support in my invoicing system, but now you're not relying on integrations, which more often than not are integrating incorrectly.
All right, I got to pick your brain about something now.
Yeah, this
Because
exact
you just,
problem
I mean,
there.
we were just talking about this, and now you're walking in here, and I was like, okay. We have a project management software
Okay.
that does the invoicing and things like that.
Mhm.
But some of our projects, they take a long time. I mean, they're 8-9 months. So we'll sign a contract, a couple $1 million, and the thing's going to be 9 months. So we'll put these invoices that, day we sign the contract, when we're going to get paid on a monthly. Then I got a QuickBooks report, and it's months down the road, and it's like people owe us money at different times, and they weren't accurate. Everything wasn't kind of adding up. It was almost like someone owed us money in the future, but we haven't done the work yet, and it was kind of confusing. And I'm just wondering how that got disconnected. And I don't have them talk to each other. Yeah.
So, in I mean, construction accounting is one of the most complex forms of accounting.
You're telling
and
us.
so, so I don't want to go too far down a rabbit hole
Yeah.
with that, but I guess my point would be, okay, you have this third-party software you're using. If you're using that information correctly, meaning you're generating invoices, you're receiving the payments, if you're job costing, you're doing your job costing in that system, great. If you're using that system the way it was intended, don't integrate it into your QuickBooks, because then someone who knows what they're doing will be able to properly push over the right information and not end up in situations like this, where maybe, I know a lot of times people will like automate invoices in QuickBooks or automate, oh, I've always received this bill. Let me just automate the bill entry for me. So now that it's, that's one less thing I have to worry about. But then you forget about it. And now you've got all these automated bills being entered, even if they're not correct. Now you got to go back and clean up a bunch of headache. It just creates more mess than it's worth. So going back to the point of bookkeeper for the data entry, use the controller for the more sophisticated aspects of performing the close and preparing those financials in a way that you can feel comfortable they're done accurately, and then you're not going to end up with a bigger mess, which unfortunately a big part of my job is coming in and cleaning up big mess.
And then the CFO is the projections in the future.
The CFO is really there they're there to run analysis, but they're more proactive versus reactive. Accounting is reactive, right? Accounting is what has happened. And the CFO's job is to say, okay, well, what is going to happen? Or what can we take from what's happened to now look into the future on what can and should happen? That's really how, at an elementary level, I would think about a CFO.
And that's what your company does. You bridge the gap between all these, the bookkeeper, the controller, the CFO, that type of thing.
Yeah, exactly. So my job is basically to provide the highest level quality financials that I can to typically professional service companies, marketing agencies, engineering firms, architecture firms. And the idea is that, hey, I treat every client like they're a $100 million client, even if they're a $1 or $2 million client. Now, you may say that's overkill. I say, okay, well, you get those processes right early on. And as you're scaling your business, it's going to scale very nicely with it. And it doesn't mean necessarily either that it needs to be a very expensive endeavor, because just doing things accurately and right doesn't necessarily mean a bunch of extra work. It just means working with people that know what they're doing, who, obviously, I'm not the cheapest guy in town, nor do I want to be the cheapest guy in town. But if you want accuracy and you want to work with someone who knows what they're doing, and you want to feel comfortable that you could talk through the financials or talk maybe proactively if you want to, or know, hey, what do I need at this point? Or what should I be considering, right? That's who we want to be. Unfortunately, there's a lot, my industry is pretty saturated now. As I kind of mentioned, you have bookkeepers calling themselves CFOs. It's pretty unregulated. So you don't really know who you're going to start working with. What I would advise is, if you decide, hey, I want to work with a third-party expert, okay, meet with them, get an understanding, hey, have you worked in my industry before? Can you give me some examples? Do you have any current clients that I can speak with, right? Do your due diligence to make sure that you can trust who you're working with as the best advisor for you. Because I think a lot of people don't do that. and they end up not being happy. And unfortunately for me, it gets put in a situation where a lot of people have a sour taste for working with an outsourced accounting firm. And what I would say is just do your heavy due diligence to make sure that who you're working with, you're going to be happy with for the long run and, has the skill set you need in your organization.
You mentioned something about kind of helping these companies grow. How do you balance that with that financial risk versus that growth? I mean, you've got to put maybe a big investment forward, and it may not look pretty. It might be off your sheets now, off your statement. But they're investing into the growth of the company. Like, how do you advise to kind of help them tackle that?
So that is a great question. So what I would say is that Finance 101 is you can't have reward without risk. And so my question to you as a business owner, if you come to me and ask me that question, is what is your risk tolerance? What are your growth goals, right? Where do you want to be 5 years from now? Okay. Depending on where you want to be 5 years from now, if we reverse engineer that, what kind of investments are we going to have to start making in the business tomorrow to get you on the path to achieving those goals? And guess what? If you've got really audacious plans and you've got aggressive growth goals, you're going to have to invest some money into the business. And you may be cash flow negative for a while. You're going to have liquidity to get you through that. These are things you should definitely think about. And I think a lot of things people don't consider is, start with where do you want to be 5 years from now? And then let's reverse engineer that.
Yeah, we can digress. I liked where you were going with kind of talking about the different statements, right? You were talking about the balance sheet, what that should look like. Maybe we continue on that even with some of those, the income statement, the cash flow statements.
Yeah.
I actually had a question for you.
Sure.
Before you came in here, we told everybody what you do, and some of our interns they're from UCI, and they thought it was pretty fascinating. They want to know about business. They're majoring in business and so forth, and they came up with some questions.
Okay.
So if you wouldn't mind,
Sure.
but I have one.
Absolutely.
So one of the first ones was, how does strategic financial planning and accounting contribute to the long-term business success and development?
Oh, that's it.
It's a loaded one, right?
That is a loaded
Every time
one.
they give me questions, man, I get the same look on my face. It's like they're so like in depth. Like I'm like, do you have three of you think of this at the same time? Like, but
so I think that it kind of, and there's a lot to unpack there. But what I would say is that if you don't have strategic accounting or finance in your business, you're running blind. You're running blind.
That's what I would say.
And what I mean by that is that you're just running the business and you're hoping for the best and you're relying on your gut. And your gut's right a lot of the time, but your gut can be wrong too, right? Let me give an example. Let's say in your business model, maybe you have 3 or 4 different revenue streams in your business. Okay. If you're not looking at the revenue between those streams and the costs, this is important, the direct costs for those revenue streams independent of one another. Well, maybe one of those streams is actually losing you a ton of money, but in aggregate, maybe you're still overall a little bit profitable, right? But if you're not actually segmenting and looking at each facet of the business separately, you wouldn't know that. And so I guess to go back to, by planning, right? In anything in life, right? If you've got a strategic plan, let's go back to what I was saying before about the 5-year. Look ahead 5 years, reverse engineer. Now you can actually say, okay, well, I'm at $1 million and I want to get to 5 million in 5 years from now. What is it going to take for me to do that? Then you reverse engineer and you build your projections. This is a little bit of the finance part of the CFO part, okay? You build your projections, what it's going to take you for the next 5 years to get to a 5 million revenue rate. Okay. And then, but now you can actually plan. Now you can see, am I on track for that every month? Okay. But going back to, you're only going to be able to track and measure if you're meeting that success, if your financials are done accurately. And what I would say is don't just do revenue projections. Okay. I said, a lot of business owners talk about revenue. I really almost don't care about revenue. I care about profit. Right, because
I love that.
You can have $100 million business that's generating you $1 million in profit, or you can have a $2 million business generating you $1 million in profit. Guess what? I'd much rather have the $2 million business any day of the week.
Yeah.
And so, yeah, it really comes down to
$2 million generating some profit versus $100 million with zero profit.
Exactly.
I'm the same way.
Exactly. So you want to project the revenue, but you also want to project, okay, what are my costs along the way? And you want to think about, okay, well, if I'm a $1 million business today and I'm a $5 million business tomorrow, 5 years from now, what else is my business going to need? Because another thing people don't consider is that as your business grows, your overhead grows. Okay. And your general and administrative expenses grow. You're going to need more administrative staff. Depending on the type of business, you may need more office space. Your costs are also going to increase. And so as your business is scaling and growing, your direct costs or your margin, your gross profit that a business is generating. So gross profit, let's take a step back.
Into gross and net and all that.
Yeah, let's talk about that because I think it's important. So you've got your revenue minus, some people may have heard of like cost of goods sold. Okay, what is cost of goods sold? Cost of goods sold can apply for service businesses, product-based businesses. It's what are the direct costs for every dollar of revenue the business is generating? What is it costing you to deliver that?
Is cost of doing business and cost of goods sold the same thing, or are those separate?
They're different because you have the direct costs. Like for instance, if I have this glass, if I'm selling this glass right here, and maybe I sell this glass for $5 in revenue. Okay, what did it cost to make this glass? And so what that means is, what did it cost me for the facility that's manufacturing this? What did it cost me for the equipment to manufacture this? What was it for the labor to manufacture? All my direct costs. I'm not talking about indirect costs. Indirect costs are overhead. Like that would be your office space rent. That would be your administrative staff. I'm talking about like if I want to create this glass of water, this glass right here, what am I having to create or build out to manufacture this? And then what is my incremental cost? So for every glass I produce, what is my cost to manufacture that? Those are cost of goods sold or direct costs. And so that's direct materials, direct labor, and overhead. Overhead meaning the manufacturing facility side of overhead, not office space.
It's like marketing can't be included in.
That's
It doesn't deliver the glass, but
correct.
It delivers it to the customer at the end.
Yeah, but that's not a direct cost. You want to look at true direct costs. So like in my business, my direct cost is my staff labor. Okay, so my labor cost for my accounting staff that work in my organization, those are my direct costs. Now in a business that produces widgets, it is what did it cost to produce that widget. But what I find is a lot of service-based businesses aren't looking, they're like, oh, well, I'm not making anything, so I don't need to look at my direct costs. Absolutely not. If you're an engineering firm, architecture firm, accounting firm, any service-based firm, the people that are doing the work that is generating you revenue are direct costs, and you should be accounting for them in your cost of goods sold.
That payroll
cost.
Okay.
Yes. So if you take revenue minus cost of goods sold, you then end up with gross profit.
Okay.
So gross profit is, if you take out the revenue minus the direct cost what was the actual profit that the business generated gross, okay? And then gross margin. So when you hear margin, it's percentage. When you hear profit, it's dollar. I find a lot of people mix that up too. They're like,
what more time was that? What was it? Margin was percentage?
Margin is percentage. So people say my gross margin last month was $200,000. No, that's gross profit. Gross profit is dollar. Margin is percentage. So it's
a good little takeaway right there.
Yeah. So if you did $1 million in revenue last month and your direct costs were $500,000, your gross profit is $500,000. Your gross margin is 50%. It's your gross profit, $500,000 divided by your revenue. So 500,000 divided by $1 million, 50%. My gross margin was 50%. Now, the reason you want good accounting is because every single month you want to be tracking your margin. Is my margin going up or down? And when people aren't tracking their margin, that's when they end up in situations where they have their margin that's been eroding for the last 8 to 12 months, and they haven't been tracking that accordingly. And now they're in a situation where they may have been able to fix that months ago, and now it's too little too late. Now you got to deal with the burn, right? Because a lot of people wait till like, how did I do last year, right? They're like, they go to see their CPA and they're like, okay, here's my financials. How did I do, right? And a lot of times it's too little too late. You need to be looking every single month at stuff.
When I hear margin, the first thing that pops in my head is pricing. It's like your pricing is going to dictate your margin or your costs, right? But if you're starting a business for the first time, you've only been in business a few years, how do you identify what is the proper pricing to know what your margin should be for your growth? I mean, that's just complicated for me even saying it.
That is complicated.
Okay.
What to price, right? So what I would say is that I don't think enough people take a deep look at, are you priced accordingly? when I think about pricing, I think about what is the value you're providing, because the more value you can provide in your business, the more of a price you can charge. The higher the price, then obviously the more profit you generate. So you want to think about pricing as value proposition for anything. So whatever your business is selling or providing, it's what value does the customer get from that experience? And the more value your customer can get out of that experience, the more price, the higher you can make that price, because that's what people ultimately value, right? Something's either too expensive or seems like a great deal. You don't want your customer saying, I'm getting such a great deal from them. You want them to feel like they're getting the proper value.
Fair deal.
If they're getting a fair deal, you're pricing it well. If they feel like you're expensive, they're not seeing the value in what you're providing. And if they're like, wow, you're a steal, that should give you a hint that your price.
That goes back to just business decisions and stuff like that.
Yeah, but there's no magic here. When you're selling a product or providing a service, you have two levers. You have pricing and you have your costs. You can either try to reduce your costs, which therefore grow your profit, or you can try to raise your pricing to increase your profit, right? Those are kind of the two levers you have. And so you want to always be looking at those two levers, but going back to the margin, you want to be analyzing that margin every month to make sure that you are hitting your target margin. Yeah. If you think you should be doing, if you think you should be doing 60%, but you're doing 50%, well, why? Yeah. Okay. And then what can you do to amend or change that? Or if you're higher than you thought you would be, also why? Why are you doing better than you expected? And what can you take away from that to help either amplify or continue that progress?
What are some other KPIs that you recommend kind of watching on a monthly basis?
So definitely gross margin. You want to look at your gross margin every single month.
And there's no one size fits all for that. There's no like, this is a healthy margin for a company, 25%, 30%. Is there some zone that...
I would say that if you're a service-based business and you're not doing at least a 50% margin, you're doing something wrong.
Okay.
So I find out, and it's funny, I want to take a step back. I find a lot of people that have been in business 10 years and they're struggling, and it's because they never should have started that business to begin with. If
I just had a podcast about this, man. Like it was like we had a business for a long time. And I think it was my own fault for getting a little emotionally attached to this business. And it was just like this, the basic economics, supply and demand, I think weren't there. And the margin really wasn't there. But we kept wanting to push it forward. And just finally we're like, you know what? After a few years, it was just not going to happen.
Yeah.
And it was one of those businesses where we shouldn't have tried to pivot and start that specific one. This was years and years ago.
Yeah.
But it was one of those stories.
Well, and and it goes back to, before you even start a business, or if you're considering starting a business, crunch the numbers. Like, does this business make sense? Because, if you're going to sell something for $1, but it's going to cost you 90 cents to make it. Okay, that's a 10% margin. You're not going to be able to grow any business on a 10% margin, right? If you want to make sure that your business is going to be number one, scalable, and number two, profitable. But I don't think enough people consider those things. But anyway, the hard takeaway is that unfortunately, I see a lot of businesses that aren't meeting the margin they should. They've been in business a long time and they have some difficult decisions to make. And some of that might be this business just doesn't make sense, right? Or you need to make some pretty significant changes in this business to scale it. Because guess what? If you're not meeting the margin that you should be, as your business grows, you're going to put yourself into a more and more precarious situation because, as I alluded to, your overhead expenses are going to grow as the business is growing, and you need your margin to also be growing as well to make sure you've got enough profit to cover that gross profit to cover that additional overhead. Going back to KPIs, I mean, look, like if you're a CFO, there's certain ratios you can look at a different analysis, but from like a business owner perspective, look at your gross profit and margin every single month. You want to also look at, a lot of people have heard of like EBITDA, right?
Oh yeah.
EBITDA is like a hot one. I mean,
I heard people that they either love it or hate that, or they think it's a great metric to look at. And other people are thinking it's bullshit. And I know that, God, who was it? Charlie Munger hated EBITDA. He was like, "That's the most bullshit metric in the whole world." Why do people have these mixed feelings about it?
So first of all, EBITDA is not a true accounting metric.
Okay.
It's a financing metric, and particularly like private equity uses EBITDA.
Yeah.
And the reason they like EBITDA is because, so let's talk about what EBITDA is. It's earnings before interest, taxes, depreciation, amortization. Meaning, like, okay, if I want to, if the company is profitable before all those things, I'm good, right? Because a lot of private equity funds will like load up debt on their investment vehicles, or they'll load it up with depreciation. If they have to buy a ton of equipment, depreciation. EBITDA is good, but if you're running a business, I want you to look at your net profit, right? You should look at like my net income or net profit. Like, how much profit did my business truly generate, and how much of that is actually like for me, right? You can get EBITDA. You may have a really strong EBITDA, but if you've bought a shit ton of assets, or you're loaded up with a shit ton of debt, and now you've got huge interest payments, it's going to maybe paint a rosier picture than you really have. So you really want to look at net income. And then so you have net profit or net margin. So once again, going to percentage, right? What are my margins? And then how is that trending? You really want to look at trends, right? Because it tells you if things are going in the right direction or not.
Do you like looking at a quarter, a year? What's your?
I like looking monthly.
Monthly,
because I want to know, like, are things trend? Because the more frequently you look, the more quickly you can pivot to making decisions or changes that will affect the outcome. If you wait quarterly, okay, now that's 3 months where maybe you had a really shitty quarter last quarter, and now you're, several months away from making changes. Whereas if you do it monthly, you could be a little more proactive to make some of those changes, because maybe you thought a cost in this area was X and it's really X plus Y, significantly higher. And it's like, oh shit, I gotta change that right now, right? So it'll give you more of that. It'll give you more of that that visualization or that data you need to like quickly pivot sometimes, to prevent incurring additional losses.
Yeah.
Yeah. Something that you kind of touched on a little bit, like profit versus cash flow, but you get a lot of these companies that run into trouble cash flow wise, but they're profitable on paper. I mean, explain that. Like, what are they missing?
So there's a saying. It's funny. So there's a saying, right? Revenue is vanity, profit is sanity, cash is king. I've never
heard that one. No, I've been doing this for 13 years. I never heard that. I love that.
It's funny. If you go on my website, that's one of the first things I read is revenue is vanity, profit is sanity, right? Revenue, like I said, I don't care what your revenue is, really. It means nothing to me, because you can have all the revenue in the world, but if you're not profitable, who cares? It doesn't matter, right? They say profit is sanity, because obviously that's telling you truly how the business is doing. And they say cash is king, because obviously when you have the cash, then you're good. I am, being in my business, I know a lot of companies need liquidity, right? So I look at profit as also king, because if you've got the profit, we can help get you the working capital or the float you need. As long as the business is profitable, you can go to banks and you can get the funding, or you can find investors. You can find ways to overcome those challenges. But you need that profitability. Obviously, it needs to be accurate, and you can get the working capital you need. So what I would say is that if you find the business is really profitable, but you're running into cash flow situations, well, first of all, number one, if you're taking a ton of discretionary through your business, like maybe you need to look at that, right? Because a lot of business owners, they run a lot of personal things through their business. Okay. And if that's negatively impacting your ability to sustain growth because you don't keep enough working capital in the account, well, consideration. And number two is like, make sure you've got the runway, right? Like, I've got a $250,000 line of credit. I don't touch it, but guess what? It's there in case I need it, right? You always want to be ready for a rainy day. And I think that's a lot of things business owners don't do either, is they don't prepare for a rainy day, right? Get the liquidity you can as soon as you can to be prepared for any situation that may come. And guess what? If I have the ability to, if somebody came to me tomorrow and said, hey, you need to make this investment and it's going to generate this return, I've got the ability to do that. So I think it goes back to make sure you've got the capital runway to help sustain any situations where maybe there is a rainy day, but then also to give you the leverage to grow the business when the right investments can be made to help you do that.
Yeah, that's interesting.
If someone was starting a business for the very first time, and would you recommend that they go to someone like you from day one, or they try to do this themselves for a little bit to get the ball rolling? And then, I mean, I know you don't, but when would they outgrow a company like yours and have everything in house? Or, I mean, is there a sweet spot that you like to operate in or you recommend?
Yeah, so I think a good starting point when you're going to start a business is actually how are you going to form that business and why, right? Because I think a lot of people too, I mean, look, S corps are really popular and S corps are great, but S corps don't always make sense, right? Sometimes you should be a partnership for certain reasons. Sometimes you should be a sole proprietorship for certain
Oh, that's
reasons.
something good to touch on because we have an S corp, LLCs, an LP. We have a few different things for different assets that we hold, different partnerships that we have, companies, so forth. But what are these differences? Like, what should I mean?
Yeah.
I'm almost embarrassed to say that because we have them all. Brad and I own all these, but we have accountants and lawyers that set this up for us, advising us on what is the best to hold these different things in.
Yeah. So let's go back to, so let's start with like a sole proprietorship is what, probably 95% of all businesses in the United States are. And these are tow truck drivers, nail salons, right? This is what actually it goes on your personal tax return as what's called a Schedule C. It's a sole proprietorship or small business
And you would say
entity.
90 something percent? Like they don't even
Oh,
set the LLC up or something
yeah.
super simple, huh?
Yeah, and there's a
Wow.
lot of, and we'll kind of touch on it. There's a lot of times where I feel like people are getting LLCs just to get LLCs. They don't need them.
Yeah, okay.
It's very hot. People want to say, I'm starting my LLC. And it's like, you don't really need an LLC. If you're unsure where the business is going to go, start as a sole prop.
Yeah.
If there's not a lot of risk in your business, or if you're able to mitigate that risk by a really good insurance policy, just start as a sole prop. It's the cheapest, easiest way to start.
I was always kind of thinking the liability standpoint, like that there's at least something there to protect you
I heard an LLC without a partner doesn't even, it like almost defaults to
from
a sole
a
proprietor,
tax
doesn't it? From a
standpoint or
tax
something.
standpoint.
So yeah, let's. So I don't want to lose my train of thought, but I will get. No.
Sorry
Sole
about that.
proprietor.
My
No,
fault.
that's okay. I want to get there because that's
Okay.
important. It's like I see a kid coming out of school who don't have a nickel to their name, and they want to go run out and spend $800 to form an LLC because they want to start their side hustle. You don't need to spend the cost of because keep in mind, depending on what state you're in, you have franchise fees. In California, we pay a minimum of $800 a year to keep
Whether
that
you make
LLC.
money or not.
Whether you make money or not. And then depending on how the business is structured, you may have to get a corporate tax return or, you have these additional costs. So going back to it, it's like, analyze, like, do you need an LLC? And let's go back to like what an LLC is. So an LLC or a corporation is a limited liability. Right. So as long as you aren't doing anything nefarious or illegal, you limit the liability to the entity that's held it. So if that business were to go bankrupt, it won't affect you personally. Right. And so obviously for people that have assets, if you own a home and you want to start a business and there's risk in that business, get an LLC or form a corporation. So now what's the difference between a corporation and an LLC? Okay. LLC is just a state recognized limited liability company. The IRS doesn't recognize LLCs. You would form an LLC in the case, we're in California. So if you go to the California Franchise Tax Board and you form a limited liability company, you now have that limited liability protection. By default, if you're a single member LLC, you're a disregarded entity. You default to being a single member LLC sole proprietorship. Now, you tell the IRS how you want your LLC to be taxed. And so you have a couple options. If you're a sole owner, then you can either be a Schedule C or a sole proprietorship, or you can be a corporation. Or if you're a multi-member LLC, then you can either be a partnership or a corporation. And like I said, depending on what the business does, it might make sense to be a partnership. It might make sense to be an S Corp. It might make sense to be a C Corp. Because there are rules around C Corps where you can have a $10 million capital gains exclusion, depending on what the business, there's different. And so I guess my point is, if you're starting the business, seek advisement from someone to just make sure you're setting up the right kind of business, right? Now, where does somebody like me come in? I would say somebody like me comes in to where when the business is, you could see that this is a viable business and it's growing, and now you need to actually start looking at your financial data to help you start to make decisions, and you need to start making investments in the organization. That's when you need to work beyond a bookkeeper. You should have a bookkeeper from day one, right? But when you're going to like a controller is when you need to know that the financials you're looking at are accurate and you can take advisement away from those financials to help you better run the business. Now that might mean when you're at 500,000 in revenue, that might mean when you're at 3 million in revenue. I would say if you're at $1 million in revenue, you've got a viable business, you probably should have a controller, a fractional controller on that point. And that doesn't mean that it needs to be extremely expensive. You know, a controller might be $1,500 a month. But that $1,500 a month is going to go a long way into giving you a lot more advisement out of the business. And it's going to really help you propel your understanding of what it's going to take to continue to scale and grow the business.
Yeah.
That's some great advice right there. I think a lot of people that are starting a business for the first time, they have questions about that. And I see sometimes they take the steps of, oh, I want to get this LLC. I want to design this logo. I want to do this. And it's all these other little things. And I always say, just go sell something. Just go
Right.
out there and find someone that wants to buy whatever that's your business right there.
Yes.
After you start selling something, you can back into a lot of this other stuff. You don't need to go get a business license from the city of Irvine. You don't need to do all these things just yet. Just go try to sell something first. That's your step one, and then move down the line.
I got a funny story. So my wife is a therapist, and after she, got her hours, went to USC, she decided I wanted to be in private practice. I'm like, great. Okay, so we got her an office, got her formally set up, did the business license, all that. And then, she just thought that, okay, I'm just going to sit at my desk and like people are going to start calling me now. Like, oh, now I'm a therapist. Oh, the phone's going to start. I'm like, babe, that's not how this works.
Yeah.
Like, you need to go out and network. You need to go meet with other therapists. You need to go meet with doctors. You need to go into networking groups. Like, the business doesn't just come to you. And I think a lot of people that aren't entrepreneurial, that they don't necessarily know that. They just think, oh, it's so easy. I'm just going to start this business and magically it's going to take off. It's like, no, you have to know how to sell.
100%. I mean, our first business that got us to where we are now was design and construction for small businesses going into brick and mortar for the first time. It's intimidating. You're going to go sign a commercial lease at a retail center or something and then build out this store. There's a lot of moving parts. And Brad and I saw a gap in the market there, and we decided to go start a business. And we did. We were successful for years and years and years doing this, built hundreds of stores. But when you do that, you get to see the people's the financials and the business plan. And it's shocking to see that you'd look at the business plan, they'd have money for the construction, the design, the logos, everything, but there'd be no marketing, no advertise, all these different things, no even runway for operational for 6 months. So we'd be able to be so good. We could sit there. I mean, it's kind of bad, but we'd be able to sit there and look at these business plans and understand, well, this person's going to make it. This person's not. And we used to be able to do that, and we were pretty accurate. And it was unfortunate, but those are things that are overlooked a lot of times.
Yeah. And I mean, obviously there's a gap in the market. And I think I don't know if you're still doing something like, but there's definitely for anyone listening that, it sounds like there's some good consulting that can be done in there to just, have people understand, like, before I even go and make this huge investment, does this make sense? Do I have everything I need? I think to your point, a lot of people they don't understand or consider the runway, right? Because I mean, a lot of businesses will burn money up front for a long time. Do you have the financial runway to carry you? I see this a lot with, everyone wants to open up a restaurant. Like, people think like, oh, I'd love to own a restaurant. It's like, okay.
That's what we specialized in, man. Just building those out.
I mean, like, do you have her inventory? Do you realize it's going to take, word of mouth it's going to take a long time before that restaurant starts being, is busy. And you got a lot of carrying costs. You got to make sure you've got float for it.
And then to your point earlier, the margins in restaurants are small.
They're capital intensive to get open. Yeah. You've got staff, your vendors, everyone's trying to kind of screw you on the back end.
Yeah. Super competitive.
We see it firsthand. It's, we see them unfortunately go out of business before they even get open.
It's funny. It's one of those businesses where everybody it's like having a lure of like, I want to open a restaurant. And I don't know if it's because they want to have they just like, they want to have a place to like take their family and their friends. But I feel like it's one of those things that like people get a little bit of of economic success, and they're like, okay, I'm going to go up in a restaurant, and it's like that ends up being a they don't think about the hours, intensity, but like you can please, like anyone listening, like consider all of these variables before you start any business. Number one is like, okay, is it scalable and profitable? That's at least how any business that I'd be looking at, I want to make sure it's going to be profitable and scalable. If you were to take what you're doing now times 1,000 or 1,000,000, like how is that going to amplify? And are you going to have what you need to grow that organization?
Understand all these variables, but eventually start to. That's one of the things as well is there's a lot of analysis paralysis.
Totally.
And you and I, we're both an EO. And it's like that EO has the EO accelerator program up to, I believe it's 250,000, that if you have a small business that makes that much, you get an EO accelerator. And then up to EO, it's over $1 million. And I think they have a lot of tools and things like that to learn and to grow. But if you never take the first step and you never get started,
absolutely,
then it's like you'll never, you're going to have some bumps in the road and some lessons along the way. But just try to do a little research and
Absolutely. For anyone listening who, I joined EO about 2 years ago. I wasn't in EOA, the accelerator program.
Okay,
I wish years ago I had something like this.
So do we.
We would have learned,
Great
I had to
events.
learn the hard way on so many things. And I feel like the more education and the more mentorship you can seek in your entrepreneurial journey, the better. But also just for anyone listening that's maybe starting a bit, like just know it's going to suck. Like,
and it sucks for everybody.
Yeah.
So it's not like even if you see someone that just seems like they had instant success, maybe that's super rare, but usually there's a lot of bumps in the road you just aren't seeing.
Oh, for sure. You get the one unicorn, one out of a million gets instant success. But running a business is hard. It's going to be tough. It's not going to be easy. You're going to have constant challenges. If you're built for that, it's very rewarding, but just it's not easy. It's not easy. So don't expect, if you're working a 9 to 5 and the allure of owning your own business sounds appealing to you, but you're maybe an introverted person who isn't very good at sales and can't get out of your own way. Those are two probably red flags right there. It's like, can you sell? That's number one. If you can sell, great. Then you can at least, I think, start the entrepreneurial journey. And then the next step is, can you get out of your own way? Meaning, are you not so arrogant that you think you always have all the right answers? Because I see that all the time as a real limiting factor. It's like, nobody knows better than me. I know this best. No one's going to tell me otherwise. And you limit yourself. And so I think if you've got those two things in you, if you can sell, and if you're willing to bring in smarter people around you to help you run the business, those are two traits right there that'll at least ease you into an easier journey.
Yeah.
Through
I love that.
I put a quote out the other day. It was like, the harder I work, the luckier I get.
Yeah.
Funny.
It's true.
Isn't that funny?
Yeah. It takes grit. That's for sure.
Yeah,
for sure. Well, Brian, we've taken up about an hour of your time.
Jeez, yeah.
But that flew by. I think I learned so much. It was awesome. But thank you so much for being in the Hive with us. Loved having you here. And I think that'll do it for today.
Thank you.
But thanks
Appreciate
again.
it. That was great,
Thank
man.
you.
Thank you. This was great.
Awesome.
3, 2, 1.